Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest episode of the ASB Investment Podcast. I'm your host, as always, Nigel Grant. And in this episode, with our feature guest we're chatting to is Patrick Washer. Now, Patrick is the portfolio manager at Devon Funds. We work with Devon as one of our underlying fund managers, with them looking specifically after our Australasian equity income portfolio. But what does that actually mean in reality? Well, it's managing a group of quality companies that provide attractive, I love these words, sustainable dividends for investors. So today we're going to get you learning about a bit more what's going on in this investment landscape of these companies, what's been happening with some of their dividends or what's happening in reporting season. But a lot of these companies, you as ASB investors, or even if you're not with us, you might actually own in your own portfolio. So welcome to the podcast, Patrick. It's good to have you here. How are you?
Good. Yeah. Pleasure to be here. Thanks.
Great to have you on the couch. Can you tell us a little bit more about, a day-to-day office life, what it's like for you, and then also anything you get up to in your spare time?
Sure, yeah. So I kind of have made a habit, I find, of waking up and instantly thinking about stock prices and checking my emails, but I try
too?
I try not to do that. Yeah. I try not to do that. But yeah, so usually get out, do some morning exercise, get into the office about 8.
Okay.
And then in this day and age, what investing is really, information's very available now with all the, Bloomberg terminals and the big data and everything that's out there. So what you're really trying to do is take a read through of all that available information and make decisions, right?
Yep.
So that's what we do. And as a result, in the morning, it's usually a lot of reading newspapers, read several newspapers, read all the company announcements, read broker research.
Oh, I love it.
Yeah. And then thankfully I like reading. And then markets open at 10 a.m, so you might make some changes, discuss it with the team, make some changes to the portfolio, and then you'll typically look to do spend the afternoon doing research on new stocks or existing positions. Yeah.
And do you ever, is the 10 o'clock deadline like almost like a ticking time bomb, or you've got to get all that reading done and stuff?
Yeah, I mean markets are everywhere in the world. There's some price moving on some information.
Yeah,
so
true.
I suppose if say in reporting season, right, a company is going to release the results at 8:30 usually.
Yes.
So you only have 90 minutes to sort of synthesize all that that information and make a decision, perhaps, but I mean, stocks trade throughout the day, so
yes, sure.
Yeah.
And anything in your spare time you do when you're not reading and deciding?
I'm a wonderfully average golfer, yeah. So, yeah. So,
okay.
Went to Scotland this year on a golf trip with some of my buddies and stuff.
Far out.
So, yeah, no, it's good. It's good.
What, any famous courses?
Yeah. So, weren't able to play the old course, but played Kingsbarns, Carnoustie, North Berwick, whole raft of them. Yeah.
So basically your own
Royal
little
Dornoch,
mini tournament.
Yeah.
Fabulous.
I wouldn't have made the cut in any of them, but yeah.
You still win, that's fine. All right, let's crack on. So NZ had the first cut, as we all know, in August, the OCR, with many picking, there's more to follow towards the end of the year. What is Devon picking in terms of, these cut decisions or the path, and what impact will that have on our local market?
Yeah, sure. So where the RBNZ have estimated that you're going to get a 25 basis point cut in October, next week in November.
Yep.
We think that we aren't a macro investment firm, we're a bottom-up fundamental investment firm, but at times you can't help but take views on these things. And
just that means you look at the companies first and then work out.
So we've got 3 statement financial models on all these companies. You spend a lot of time trying to understand sector tailwinds and fundamentals that actually drive company specific performance versus a top-down approach of we're cutting rates, we're buying equities kind of thing.
Carte blanche.
But anyhow, so we think that we agree with the UBS economist where we think that you're going to get there's a good argument to get 250 basis point rate cuts.
250 before the end of the calendar year?
Before the end of the year, yeah.
250?
So it would take us to the end of the year to 4.25%. Not saying that they will do this, but the facts, which I'll touch on in a second, sort of support that
I like this tease. It's great.
And if we think about it as a baseline, so there's a concept called R star, which is the neutral rate of interest, whereby it's the rate that the OCR should be such that the economy is neither growing nor shrinking, right? And that is, no one knows what it is, to be honest, but say it's 3%, right? So currently we're still in a really restrictive state at 5.25.
Yeah.
And they absolutely did the right thing at this coming out of the pandemic to slay the inflation dragon.
Yes.
Inflation's not good for anyone.
No.
And it hurts particularly middle and lower class people who own less assets, because
Yep.
typically assets do well during inflation times. But anyhow, so we think that to get to 4.25 is still meaningfully restrictive, right? But it's material reduction. Reasons being is that if you think about our employment market, right? So there's a quarterly survey of business opinion, and that there's many things, one of which is employment intentions.
Yep.
That pool of companies and SMEs and things which are surveyed, they're predicting no growth in their employed base, right? This is the worst reading since 2009, okay?
Far out.
Throw in that we have several large corporates like, say, Fletcher Building have upped their cost out from 120 to 180 million. Obviously, not all of this is going to be people. There's going to be There's a lot of other areas of cost. But there will be an element of further reduction there. Spark, which is
Massive company.
And they're looking to save $50 million in their FTE base, right? So there's some innovation that can be implemented with programs and things at call centres and stuff, but this is a lot of people that are going to be laid off. And given that the employment market's really tough, CPI, they're predicting year on year in the August MPS statement that it's going to be 2.3.
Yes.
Keep in mind that insurance, right? So insurance, everyone that owns a house will have got their recent premium bills.
Yep.
They're well aware that those have been up, say, 15%. So within insurance, commercial lines for businesses and things, those are now negative from being quite strongly positive for a period of time. Personal lines are, say, 0 to 5%. Insurance alone is, say, 40 basis points of the basket right there, okay? Petrol, oil, overnight, there was some, tension in the Middle East. Yeah. But margins and petrol versus the oil margin there, the sort of spread there, those can continue to come down as people see at the pump and things. And just broader demand backdrop for, say, retail. Everyone knows that retail is doing it really tough right now. There's anecdotes of, and this is, I guess, one area where the central bank says that they're data dependent. They don't really take much notice of anecdotal feedback, as where investors are much more anecdotally driven because we're trying to get ahead of the curve.
Yes.
And the retail inflator, so typically this has been positive, so retail prices trend up, particularly during COVID. This is now negative and the worst it's been since the mid-90s, right? So we have a lot of...
mid-90s?
Yeah. So prices, generally retail prices would trend up, right? You've kind of seen this.
Yeah.
And if you walk around town, you'll see more sales, bundling things. And keep in mind that this is negative off a very high base.
Yeah.
So prices have just...
They've gone up.
They've gone up a lot, and now they're coming down a little bit. So the point being that you've got that, and then New Zealand has a really large portion of our GDP basket, which is related to residential housing. This creates quite a wealth effect. So your house price goes up $100,000, your borrowing capacity increases, you buy the new boat, new car, batch, whatever.
Yeah.
Given that HPI is flat to down actually in recent months, you don't have that either to drive demand forward. So the picture's quite negative.
Sounds like it.
Yeah, it is. There's a point where bad news is good news, because that means our cost of capital reduces, the OCR will come down, and it's just the rate at which they reduce that. We operate in a world of risk and reward, risk and return, and you try to make good risk-adjusted bets. Having the OCR where it is currently based on that fundamental backdrop is quite a bad risk bet, right? So their mandate now, they no longer have a dual mandate. They've only got a mandate for inflation to be between 1% and 3%. Yeah. Given the trajectory of this, it feels safe to assume that they're quite far behind the curve. In our
Based
opinion.
on how you've described those factors.
Yeah.
And so all of the aforementioned, how does that flow through to, I guess, the NZX?
Sure.
And companies.
So New Zealand, the New Zealand market's quite a yield-sensitive market. So we've got a lot of REITs exposure, infrastructure, and, say, gentailers. So for a long period of time in the 2010s, New Zealand outperformed really strongly versus global companies, right?
Yep.
Recently, it's underperformed. Partially that's because other indices and countries have more tech and other sort of more
US,
growth-focused. New Zealand's lacked that, but we are quite yield-sensitive. So as cost of capital comes down, it will affect every company differently, right? Because rates aren't getting cut because things are good, right? Our real GDP growth, I think, is negative 0.5 US is +3,
Yes.
and Australia is above 2, right?
And we've been like that for 2 years.
Yes, yeah. So
take.
we're in a recession, right?
Yeah,
So things are bad. So as interest rates come down, that'll obviously affect the cost of borrowing, so that gets cheaper.
Yep.
Asset prices, which are sensitive to the cost of capital,
Yes.
say REITs and things, they will do quite well. Property should do quite well.
And just for listeners though, real estate investment trusts.
Real estate investment trusts or LPV listed property vehicles.
Sure, right.
Yes, so these things will do well. However, because the economy is weak, other companies will struggle, right? So if you're particularly consumer facing or have experienced a lot of OPEX growth over recent times, you're struggling to earn that back at the top line, you're going to do quite bad. So hence why it's hard to make broad brush decisions, statements, around everything does well. But in general, interest rates are effectively gravity on asset prices. As interest rates reduce, asset prices go up.
Yeah.
And dividends, for instance, are a function of capital companies' earnings and their capital demands. So if your earnings are under pressure, then your dividend growth is going to be muted. However, there's other companies such as, say, REITs in this example, where your main cost of debt is...
your main cost is debt.
Debt, yeah. So as that reduces, obviously they've hedged for a period, but as that rolls off, dividends will be under less pressure.
Yeah, and I guess some of those companies you were saying, like, yield sensitive market, I guess as well, you've got, if you're getting 6% down the road, maybe in a TD, and you've got dividends over here, that trade-off looks a lot more attractive, right? As the right hand, which is for the listeners, was the TD option, as that decreases, over here looks better.
For sure. And I guess the pass-through is, as rates come down, it's very good to have a hurdle rate of investment in the economy, right? So we want, when rates are at zero, that's not good for anyone long-term because you get a lot of malinvestment. So projects which wouldn't have previously ticked enough boxes now suddenly make sense and money's very cheap and you get a lot of...
darts at a dartboard type thing.
Correct.
Just throwing,
Correct. And so it's really good to have an option for savers to keep money in the bank. However, there's been a period of time, obviously, which everyone's enjoyed, whereby savers were able to enjoy really good interest rates, right? And understandably, you'd take your money out of riskier assets.
Yeah,
because why would you take the extra risk, right? However, as the OCR comes down, the pass-through to savers can be faster than to borrowers. So borrowers... say I've got a mortgage, I had it fixed for 5 years.
Yes.
You don't get the same usually when you're a saver and you have money in the bank, right?
Yeah.
So it can just be on a spot exposure or whatever. So as that comes down, depending who you are as an investor, you will still have the same demands for income because your expenses haven't really changed.
Sure.
So as a result, you may see, and it would be my base case, is that you'd see money flow out of savings accounts and back into say the REITs, gentailers, certain other high quality, higher yielding assets.
And the picture you've painted, with that in mind, what stocks, I guess in NZ or Australia for that matter, have shown resilience in this period, and what's driving their performance?
Sure. So in recessions, typically the stocks that do well are less, exposed to the economy. So you've seen, say, healthcare, right? Demands for healthcare don't really change terribly year in, year out. Still get sick and you still need healthcare. And what you've seen is through COVID, Fisher & Paykel Healthcare, which is one of New Zealand's great success stories, has done really, really well. So during 2020, they sold basically every humidifier and ventilator, air quotes, they could around the world. And as a result, now what they have are sales teams in 50 countries versus 30 then, right? So what they're doing is this process of you've got all this hardware out there and now you're trying to sell the consumables or masks for that hardware. And you've seen them do really well. They're up, 49%, I believe, year to date. So they've done really, really quite well.
They're back.
They're back. They've after a period of indigestion, they're doing really well.
And any others?
I guess if you want to talk about Aussie, there's in Aussie it's really peculiar. We've seen banks and insurers be really resilient. So insurers make sense. Insurers, you've had, as we just mentioned, really good premium growth. You've had limited claims costs because costs to repair things have got cheaper because there's more capacity in the building sector and such. And then same with yield-sensitive borrowers, their investment income has been really good, right? So you've had sort of the triple whammy. Suncorp sold its bank and you're going to have capital returns, and that's done 80% over 2 years, right? So this has done really well. However, while there's still positive things within the investment case, you have to be a little bit more careful because, mean reversion is one of the great truisms of capital markets. So that which has done well won't necessarily continue to do well. We've seen healthcare in New Zealand perform really strongly, and Aussie insurers and banks have done well.
Okay, so these REITs we talk about, Real Estate Investment Trust, or LPVs, you were saying, they are listed property companies on the local, I guess, exchange, and there's obviously some in Aussie as well. They've had a tough run since, through that tightening of policy settings. Can you provide a bit more flavour as to why they're so sensitive? Again, we talked about debt and anything else, and why they're an attractive means of income generation.
Sure. So REITs are typically, as we enter a cutting cycle, the first asset class which outperforms.
Reason,
yeah,
right,
yeah,
okay,
yeah. So reason being is that if you think about what a REIT is, it's a property for which you earn a stream of income through leases, and your major cost is really the debt that you've borrowed against the property. So as rates come down, typically that stream of cash flows from the lease is unchanged, and your cost of debt will have reduced. Versus, say, other companies, which as rates come down, will take longer for them to outperform.
Sure. So it's instant margin, or
yes,
the jaws open up.
Yeah, in many respects. So typically they've but they are very interest rate sensitive. So as rates go up, that stream of cash flows is worth less, and the cap rate on the building increases, right? Which means that your values come down, your NTA comes down.
Yeah.
However, we're currently in a period where NTAs and cap rates have largely rebased to. It's quite a painful process, but they're largely rebased to where they should be based on spreads, which is the difference between the cap rate and your risk-free rate, being 10-year of, say, 200 to 300 basis points.
Yes.
So we've had that rebase, and then as rates come down further, we may get some cap rate compression, so values go up, but that is unlikely to happen immediately. However, what we've seen is that, say the large three REITs in New Zealand being Precinct Properties, the office owner, GMT, the industrial owner, and Kiwi Property, which is a diversified but largely retail.
Like Sylvia Park, is it?
Yeah, correct. Yeah. Those companies, being Precinct and KPG, while they've done really well this past quarter, up mid-teens, say 12%, they continue to trade below NTA. So there's some more
is that net tangible assets
per share. Yeah. So we continue to see some upside there, and we think that they should be able to perform still fairly strongly.
Sure. And into the other one I wanted to talk about was the gentailers. We've talked a little bit about, they make up such a massive portion of the local market. And with a lot of news lately, you've got, I think, TY's being kept open to the aluminium, it's always hard to say, smelter. Contact proposing to buy Manawa, is it? Are all these companies fairly similar, or, are some more favourable than others?
So I guess they all do the same thing where they generate electricity and they sell it to both residential consumers, being us, and large corporates. Yeah. The key difference is how they generate that electricity and what their development pipelines are. So in New Zealand, we've seen from 1970 to 2009, you had electricity demand growth largely in line with GDP, right? Which makes sense because the activity in the economy grows, that needs power, things grow.
Yeah, makes sense.
Since 2009 till the start of this year, it largely flatlined, right? And the reason being that you think about, for instance, there's a lot of efficiency gains, and you say your housewares. Yeah. So appliances got a lot more efficient. So even though we were building more houses, we weren't necessarily using more electricity. Couple that with that we've seen during the period some of the local mills and things close.
Yes. That manufacturing.
They use a lot of power out in Kaurau, the timber or pulp and paper mill that closed. Yep. And however, what we've seen this year though is a reversion to trend where we've seen demand growth. So, for instance, in July, electricity demand was up 6% on the prior year, right? That reverted in August to -6%. The reason being is that wholesale prices went so high, right?
Yeah.
That was largely driven by a lack of supply with fuel. So in New Zealand, we are lucky. We've got a lot of hydro assets.
Yes.
However, we had some of the lowest lake levels in several decades, right? Yeah. Couple that with annually we use 150 petajoules of gas, and we only produce currently 140, right?
So we had a massive imbalance.
Yeah, so we had a gas squeeze, we had low lake levels, and there wasn't much wind for all the wind farms we've built, right? Yeah. So what happened is that prices shot up, and then you had, they call it demand response, and we had corporates shutting down their production because it was cheaper to return the power you'd secured to the power company and maintain your plant than it was to produce the item.
Was far out. Yeah. So just to shutter for a little bit, get the power back.
Yeah, basically. Which ultimately is good for the sector in the near term because, we've had lake levels have now normalised quite quickly. Weather happens, and we're through the worst. June and July are the highest risk periods for lake levels because we're the furthest from the snowmelt, and we're through that. Lake levels have normalised. The gas situation will require likely an import terminal, and there'll be a lot of political noise about that.
It's like LPG, liquid.
Yeah. So New Zealand still needs gas. Gas is a great transition fuel as it effectively can form peaking energy. So you can quickly turn on a gas peaker when prices go too high.
Yes.
And it provides power to the system and prices come down.
And half the emissions profile, I think, of coal.
Yes. Yeah. Ironically, now we're burning more coal than we really ever have. And this is the...
Are we?
Yeah. So this is the issue with the transition to renewable energy will continue to occur. But what we're largely building is non-firmed assets. So we're building solar and wind. Those assets are great when they're producing power, but they have what's called a capacity factor of, say, 20 to 30%. So they only produce power 20 to 30% of the time. So
is that intermittency?
Yeah, basically, the intermittent power generation. Gladly, we do have Contact who have built Tauhara, which is a geothermal plant in Taupo, and assets like those are really valuable. But it will just be a lumpy process, I guess, until we've really got through the transition. And this is the role that, say, Huntly, with Genesis' portfolio, has to play over time. And within the sector, pricing differentials are quite high. So you've got, say, EV/EBITDA, so enterprise value to the earnings. Meridian's the highest quality player at 16 times. Genesis is at 8.
Right.
Genesis just need to learn how to monetize Huntly in the years it's not needed.
Yeah.
So Huntly's not going to go away for many, many years.
So
it'll just be useless.
So when you're driving through Huntly, making fun of it, you should stop and reflect and say that's a critical asset.
It is a critical asset.
Okay, right.
Yeah.
Okay. When you're stopping there for your KFC or your McDonald's, maybe go out to the lookout and just collect the power station.
Yeah.
And looking across the ditch, I guess one thing we were talking about before we started was, this recent Chinese government stimulus announcement. How was that flowing through to their mining sector over there? Yeah,
sure. So the mining sector is very important for Aussie. BHP alone is 10% of Aussie corporate tax take, right? So it's a huge taxpayer.
So it's just as important as the Huntly power station? More.
Maybe more, dare I say. Anyhow, so, the sector's been really volatile as of late, and, it's really been a function of, while these companies do factor in the longer term supply and demand fundamentals, prices do follow the underlying commodity price quite actively. Yeah. So at the start of the year, iron ore was about $150 a tonne. It got down to sort of around 90, and then following the recent China stimulus, you've seen it's back above 100. Yeah. And as a result, the share prices have followed that. But, the outlook for China is, I think investors must remain open-minded because it's so changeable and such a different recipe to what we've seen recently. Like, on one hand, Japan, following the asset bubble with the housing market and everything they experienced several decades ago, was also the second largest economy in the world, also experienced a housing boom. And it went on to sort of underperform for a period of time.
Flat. Nothing.
So on one side you've got that, and then on the other side you've got China has a unique ability to generate growth when they need it and to hit targets and things. So it's very opaque and difficult. But we've got Tama, who runs the general Trans-Tasman strategy for the ASP investors.
He's been on the podcast.
Yeah. So he's going up to China end of this month, actually. So that'll be really valuable.
We'll have to get him on.
Get him on.
And so companies in growth sectors such as tech and renewable energy, which you've talked about, how are they impacted by tighter monetary policy in both markets at all?
So I suppose on tech, loss-making tech becomes much harder in higher interest rates times because A, money's more expensive, and B, when reserve banks lift the cash rate, think money gets basically tighter, right? And investors lose their optimism that they would have once shared when rates are zero. So these companies can find it more difficult. However, you have seen the many examples generate quite strong growth through the period. That's positive. And then renewable energy will continue to occur because the world is tilting that way away from fossil fuels. And it just really matters about feasibility studies and at what point can the cost of debt finance the venture such that it's accretive.
Yeah, sure. And the final question before we get into sort of recommendations was, are there any particular companies that are presenting really strong, I guess, fundamentals? That's what you guys look at, or opportunities, and then, the counter side, any on the other side that are not looking so hot?
If you have a good quality cyclical exposure with a supportive industry tailwind, with be it pricing or consolidation or whatever industry share, companies like that should do fairly well as we enter another economic cycle. Because while things are really difficult now, things don't stay that difficult forever, right? Things will get easier. And companies we like Freightways, say, which are the parcel operator largely around New Zealand, they operate in now an oligopoly structure with just themselves and NZ Post. NZ Post has invested hundreds of millions of dollars in automation.
Yeah.
With the current government, they're pushing them to start to earn a return on that investment.
Yep.
So we're seeing prices lift in the sector. Combine that with same customer volumes currently down 5%.
Yep.
And that will stop declining at some point. And at that point, they're currently gaining 4% market share. So you sort of lay those two on top of yourselves, and
some good tailwinds.
You should have pleasing top line growth, and then they'll win back margin over the coming years.
Yeah, so anything that's got the sort of the not got a tailwind.
I think things like, say, retail, you have to be still quite careful with. Yeah. So good retail like Briscoe's. Briscoe's just had it's run by Rod Duke. Yeah. He's started as a 14-year-old shoe shiner in Melbourne. He's a true merchant.
Yeah.
They had their record first half ever, right? And
this year?
Yeah.
And this type of year, sorry.
Totally.
Yeah.
But then on the other hand, you have companies like, say, Kathmandu, which are really struggling. So their floor space doesn't quite fit their needs, i.e. their amount they rent is too large for what they need, and that just creates quite a lot of fixed cost in your business. As your top line suffers because you're quite discretionary, your earnings are impacted. So
and I guess it's to your point. Like if you're walking down Queen Street, your main street, and you see lots of sale signs, you can probably suspect what does that mean for investments? Probably retailers challenged, right? Yeah,
totally. Yeah, like I'm a big fan of Peter Lynch, and he thinks that there's a lot of advantages which regular consumers have, be it in their day job or their own experience, that say ourselves have to work really hard to gain.
Yeah.
So if you're in a shop and you're starting to see inventory turn increasing, discounting happening less, there's more stock outs in a positive way.
Yeah.
Things are clearly looking up, right?
Yeah. I always think, when I think of Peter Lynch, I always think of walking around my daughter's school for a while, and every child was in Crocs.
Totally.
So
and Crocs roofed it. Yeah.
Just to wrap up, thank you for your time today, Patrick. I really love kicking the tires on, and local and Aussie, companies with you. It's always great when you can get down to talking about, we talk about sort of macro stuff often, but we actually talk about individual companies. It's always so wonderful. You can see what things actually mean. I have one final question as we wrap up, and this is the one I ask all guests. What's something that you're reading, listening to, or watching that you can recommend? I'm currently reading a book called A Course Called Ireland, which is a guy, Tom Coyne, has a set of golf clubs in a backpack and walks around the entire coast of Ireland. Did you say Course Called Ireland? A Course Called Ireland. Yeah. It's great. Yeah. It's a great book. Yeah. Anyone who's a golfer or interested in Ireland should really read it. And so what, he walks around all of Ireland just playing golf? Yeah. Loses weight like you can't believe. And no, it's really good. Only 50 pages in, but it's enjoyable. I always read if you're still going after 100 pages, that's a book worth continuing on. Yeah. My quick one was just a plug for your guys' morning note. So I just thought, it comes out before lunchtime, covers everything you need to know from overnight and the day before. So if you need something in your inbox that helps summarize, I guess it's what feeds into what you guys do as well, that gives you a good update. So I'd encourage you to subscribe to the Devon Morning Note. That's all for today, folks. Thank you again for coming in, Patrick. It's been wonderful. We'll let you get back to the office so you can get back under the hood of these companies we talked about. I think, I'm just thinking 10 o'clock. It's 11 o'clock now. I missed the opening bell. And thank you for taking the time to tune in. I hope you found the information useful and you're a bit better informed now on everything that's going on in dividends, companies, and the economy. So until next time, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.